specifically with the investment optimizer, we put it out there with whole life. Any if you've seen any of our videos, you've heard us talk about on the podcast, we put it out there and we always describe it as using whole life. And so we'll sometimes get the question, well, what about IUL? Can I not use IUL? And the answer is you can. The answer is you're building a cash value, you can loan against that cash value, and you can flow the money in and out of your investments in the same way as you do on the whole life. So the answer is it can be done. We just have to understand what the differences are. And they're basically summarized as just 2 or 3 points. Number one, the amount of money I have access to when I loan against my whole life policy compared to my IUL is a little bit different. Whole life has a lot more guarantees, a lot more predictability in the growth. And so I can get it's about 95% of what I have in my cash value is what I can get in the form of a loan. On the IUL side, it's usually about 85 to 90, depending on who the lender is. Okay.
And so, can I also add to that, and maybe you were getting there, so I don't mean to steal thunder, but I'm just going to, Rod. Many times, Universal Life has a surrender periods on it. So if I go into that and like, there are riders that I can use to like eliminate that, right? But sometimes it'll drag the policy down overall. So like one of the elements here is that most IULs, and at least if the higher performing long-term ones, are almost all going to have some sort of surrender penalty, which just means I have access to less of that money. And it could be, a period of like 10 years where I get more access each year. But if I'm wanting to take money immediately to go invest, well, I don't want to have access to only 50% of my cash value, right? I want to have access to as much of it as I possibly can.
Yeah, absolutely. So we'll call that point number 2. And then point number 3 is the whole reason for why they offer less is because on IUL, you just have less predictability on a year-to-year basis. And admittedly, it would take, Great Depression, .com busts type of 2, 3, 5, 4 years in a row where the market is down in order to create this scenario. But let me ask you this. If I'm buying the policy and I'm 40, 50, even 60 years old, I'm going to have it for the next 30, 40, 50 years. What are the chances of something like that happening? Well, they're probably pretty good. So if you're using IUL as your policy in the investment optimizer, then you just have to be a little more aware, a little more paying a little more attention to what's going on with the underlying policy. So if I was asked, okay, well, why then do you lead with whole life and IUL is kind of like an afterthought if somebody brings it up? And the answer is the very consistent, predictable growth means that when I'm taking loans against it, I don't have to worry about that underlying asset, what's happening with it on a year-to-year basis. It's going to grow. I know how it's going to grow. I don't have to worry about that. Secondly, I don't have to worry about surrender charges. I don't have to worry about having access to less cash as a percentage of what I have there, et cetera. So now going back to what you said earlier, Christian, the fact is, because IUL can be used, there are people out there who would want to use it. Like they look at the facts and they say, okay, I get all of what you're saying, but I still like this higher upside opportunity that I get with IUL. So I want to use it for my investment optimizer policy. And if that's the case, then I have no problem with that.
You know what I would say? I would say, and you basically said something similar to this, but if you are going to use an IUL to go out and invest money through, you've got to keep more cash in it. Like that's you just got to have a bigger reserve and understand that because in a given year, right, I could get a 0% return. I could still have cost on the policy. I could have some negative potential arbitrage in my loan rates. Like there's things that could happen that could negatively impact that I have to be prepared for. And so therefore, what do? Just like most things can be solved by carrying more cash, that's how you do it.